Who's joined. And sorry, we're just a tiny bit late, just waiting for the last few stragglers to come on board. Um, so today we're having our very first property mentorship webinar of the year. And thank you to my colleagues for joining me today. Let's just jump straight into introducing everyone. Sorry, that was just a disclaimer, just to let you know that this is not financial advice, and please get someone qualified to give you advice after this. A lot of these are opinions. We do have some experts here, but take those opinions as you will, and then get your own advice. All right, so here we are. I'm your MC today. My name is Joe Lombardo. I'm, as you can tell from my accent, I'm not from around these parts. I'm originally from America. I came here in 1994. I've been here now more than 30 years. I've done a lot of property investing, a lot of it with Duncan over the last 20 years. And so he asked me if I would mind hosting the session today. I'll introduce Duncan Yeltz, the head of strategic property investors. Duncan's got lots of experience in property, over 5,000 property transactions, 37 years and counting in terms of his investing experience. Just a wealth of information in terms of investment strategy and wealth planning. From there, we've got Dom. Dom, 5 years as a mortgage broker. Welcome to you. Thanks. I've worked with Dom quite a lot. He's a very knowledgeable man. Great at giving you advice. Becky, g'day, Becky.
How are you, team?
He he can't wait. He's throttled up. Becky's the co-founder of Move, where Dom works. He's a great bloke, a qualified accountant. And then last but not least, Mark, who's joined us. He's a financial planner, an SMSF expert, self-managed super fund expert, and a great guy who's great at giving good advice in terms of wealth planning. So I think that caps us off. Gentlemen, are you ready to go?
Ready to go.
Good.
Here we are. All right. So if you've received any of our emails, any of the emails from strategic property investors, you would have known that our agenda is going to follow roughly this structure, and so we've tried to keep it exactly to what has been sent out. So there's going to be three basic parts here. Part one is some of these kind of hot topic questions, right? And I know all of our panelists can't wait to get in there and start, fighting each other on who's right about these things. Then we're going to jump into part two, which is really the meaty part of this thing. It's the top 5 property investment strategies that everybody should know in 2025. And look, if you've been around as long as I have, we've gone through the 90s, we've gone through the early 2000s, we've gone through the 2010s, and each one of those kind of investment cycles has had its own little nuances. And let me tell you that in 2025, it's changed again. And so you're definitely going to learn something today from these panelists. And then finally, in part 3, we're going to wrap up with some case studies just to show you real life evidence of these things, in action. So here we go, guys. I'm going to kick it straight off. I'm going to leave this up for your reference. What does the federal election mean for investors in Australia? Is it time to buy? Is it time to sell? I know a lot of people sit on the sidelines. That's a strategy in itself. I'm going to kick it off. I'm going to throw it to you, Duncan, first. And you got let's keep it short. Let's keep it 30 seconds to a minute. Get your opinion out there, and then let's everybody else.
30 seconds. We can spend an hour and a half just on this conversation. Federal election. What does it mean for investors? It's a great time to invest. Look, the government right now are looking to get those interest rates down. We're looking at making housing as affordable as possible. They're pumping a lot of money into making investors confident again in the marketplace. When was the best time to invest? Yesterday. When's the next time to invest? Right now. So yeah, what's it going to do? It's not going to have a long-term impact on us at all.
All right, who's next? Becky, do you want to have a go?
Yeah, I can have a go. No problems at all.
Yeah.
My comments are probably along the lines of Duncan's. Whenever I'm posed with the question, when's the best time to invest? My immediate response is whenever you can afford it. If the affordability is there, the servicing is there, you invest at that particular point in time. Don't try and wait for the market to do clever things up, down. It's not a yo-yo. It increases long-term over time. Whenever you can afford it is always my answer.
Yeah.
Yeah.
Who's next, Dom?
I'll go off the back of that. Like basically just best time to invest whenever you can buy the best property that you can afford, pretty much. Federal election with the interest rates going down, it just becomes a bit easier to buy at the moment.
Yeah. Mark?
Yeah, I agree with everyone else. Like with the federal election, like there's so many uncertainties. We don't know which party is going to get elected. But one thing's for sure is that the stuff that we can control. So, like I said, with everyone, like in terms of affordability, if you can do it, then do it. I know the government with the Labor recent release of their budget, they're looking to increase the first-time home buyers as well. So they're getting onto the market as well. So there's more increased demand. So uh, with increased demand, it will just push property prices up as well. So yeah, best
Yeah,
times.
yeah. Yeah, people sitting on the sidelines, I think, is a good time for other investors to jump in. It's like, the seagull stealing a chip, right? The first one to get the chip is going to be the one that eats. So, all right, that's kind of a good one to kick off. Interest rates. What do we expect to happen with interest rates? Do we have a differences around the table? Look, Mark, I'm going to start with you this time. We'll go in reverse order. What do you think, Mark? What's going to happen with interest rates?
Yeah, look, it's actually a subject I'm studying as well. So interest rates, like the RBA has a restrictive policy, monetary policy, meaning they'll gradually reduce rates over time. So they'll look at lowering interest rates, and what that means in terms of property, right, is it'll just make property more attractive. Obviously, with lower rates, you have lower repayments. Then we'll bring more investors into the market, which again pushes property prices up. The alternate investments outside of property, you're looking at last couple of years you had private credit funds, mortgage funds that had really good yields because of high interest rates, and you also had the shares as well. So shares, we say they have an inverse relationship with interest rates. So if interest rates go down, shares go up, but we haven't seen that in the past. In particular, since COVID, we had a rising interest rate environment. Share prices have gone up, at record highs. And just recently, when the RBA reduced interest rates last month, we had a massive downturn in the share market. So, so I believe property is a attractive asset in terms of lower interest rate environment.
Yeah, we probably have time for a couple more. Dom, do you want to weigh in on the interest rate
Yeah,
subject?
yeah. So the interest rates reducing, you can already see the effects of it with the borrowing capacities of clients going up instantly. So that even though it was only 0.25, you could see already there was 25, 30, 40K extra people could borrow, which just allows them to spend more on the properties. And then as that goes down, then it becomes easier to borrow. So
Yeah. Duncan?
Just off the back of that, spend more. It's not a matter of spending more. It's a matter of the assets you can actually buy. The difference between a $650,000 property and a $700,000 property, you're opening yourself up to a lot more investment opportunities and very possibly a better investment opportunity with more capital growth or more yield or both. So yeah, that little bit can make a huge difference in the quality of what you're actually buying as well, not just spending money and putting it into the marketplace. It's about the quality as well. Yeah.
Vicky, lucky last, mate.
Yeah, thank you. The only thing I'll say on interest rates, often what I do, if you want to, I often study the 5-year fixed rates, and if banks start to move those rates downwards, that's a very, very good indication that they believe that the cash rate's going to start coming down. Because very, very rarely do they get that part of it wrong, and you can already start to see that there's some movement in the fixed rates, and as that starts to move downwards a little bit more aggressively, you know that rates are going to start coming down.
Yeah.
Good point.
Yeah. Yeah, and I think latest unemployment data shows that a whole bunch of people have left the workforce in the kind of over 50s category. That's going to increase the unemployment rate, and I think that you'll start to see the RBA see that as favorable, or that the economy needs a bit more stimulating. And yeah, I think we've got pent-up demand from people with really high interest rates that are ready to get out and start buying. All right, so that's my 2 cents. Last question here: Trumponomics. Like, man, I can't have a conversation with anyone without Trump coming up, right? Good or bad, people are very, very polarized by this guy. What's the story, and what do we think is going to happen to Australia? We've seen numerous other instances in the market, the 2000 dot-com crash. We've seen the GFC in 2008. Now we've got this other big specter on the horizon of Trump possibilities. All right, who am I going to go to first? Look, I'm going to go back to Duncan. Start us off, Duncan. What's your views?
Look, it's not just GFC and dot-com boom. I mean, you go right back to the petrol wars in the late 70s, so 79. You go back to inflation in the 80s, 89, 87, 89. You go to COVID, 2019 or 20. It doesn't matter which nine you look at, which decade you look at, there is something going on in our economy that impacts it. Trump economics is the thing at the moment. No one's talking about COVID anymore. Look, if you think about the old statement, when America sneezed, Australia used to catch a cold, or the rest of the world would catch a cold. I don't actually see that. And in my 30 years of investing, I haven't seen the American economy, even with the GFC, property prices have continued to grow. You could buy something for $40,000 in the late 80s, sorry, 70s into 80s, and that same property now in Australia is worth $1.5 to $2 million. And we've had so many different world events. Overall, yes, will our materials, will our imports, are there going to be some tariffs? Is there going to be some uncertainty in the market? There's going to be lots of little dynamics that are already there and everyone's talking about. Fundamentally, we haven't got enough property in Australia for the amount of people that live here or the amount of people that are coming in. And so very simply, it's going to put us in this situation where supply and demand is going to push the property prices upwards.
Yeah.
No impact.
All right, who's there? Somebody was jumping in.
I'm happy to jump in.
Yeah.
I'm also happy to say that I am a Trump supporter. And look, I get a lot of backlash as a result of that. But, in having a look at if Donald Trump was good enough to influence the economies around the world, including Australia, then I think we should be prepared for the second coming. I don't think that any individual could influence the world economy in any way, shape, or form. I believe what he's doing is very, very good for America. It'll have a positive impact long-term on the world economy. He's a very, very smart individual. He knows what he's doing. If you have a look at his first term that he spent in those 4 years under extreme amount of duress and pressure, he was the best performing president in 100 years, just based on genuine facts. So,
all right, mate. Look,
you know what? It's a very, very sensitive topic in our office, as Don would know.
Yeah.
And however, I'll leave it there.
Yeah, good on you, mate.
Dom,
you're gonna follow
no,
the boss, or are you gonna?
I'll follow mine with Beck. I'm following mine with Beck on that one. I'm not.
Right.
Too
Fair enough. Mark, what about you?
Yeah, look, I think the worst case scenario, right, if the tariffs do have an impact on the economy, I see it as spiking inflation again. So, if we're talking about property long term, if prices do go up, you've got that hedging effect with, increasing rent on the property. And from a superannuation fund perspective as well, if you're looking at investing property in super, wages increase over time, so your contributions will also increase, and also the contribution rate currently is at 11.5%, and come 1st of July, it's going up to 12%. So you've got these factors also increasing that will help, with the cash flow and the property in the super fund.
Yeah. And I think a point that I've heard made is that input prices, if there are tariffs, input prices for things like lumber and things like that are going to potentially go up here. So I would imagine in that situation that houses today are going to cost less than they ever will in the future, right? If you think that tariffs may add another premium there. So I think you wouldn't. It's probably safe as houses, as they say here in Australia, if you want to get and continue your investing journey in property. Well, gentlemen, that was an amazing discourse. Thank you for that. And I hope we covered those topics well for our participants. So we're gonna go into part 2 here. The top 5 property investment strategies that every investor should know in 2025 to buy high growth, high yield investment properties. And I would add to that safe, high growth, high yield investment properties. So I'm gonna pull up a slide here in a second. And I did get a comment from somebody. They said, how do you balance high growth and high yield? And I think that's another good question that we should cover. So let me click here and see if I can get to the next slide. So 5 best property investment strategies everybody should know. Duncan, I'm going to hand it over to you. We're going to kick it off with co-living, and go ahead for me.
Look, yeah, co-living as an investment strategy, it's been given different names over the years. Share house, it used to be called. People used to rent a house out and have 3, 4, 5 other tenants in there under this one head lease. Co-living is just a new way of looking at that and new way of building a property, taking a 4-bedroom, 5-bedroom home and having 5 individual leases in there. The rooms are definitely, when they're being built now, they're definitely being set up with their own bathroom. So every room's got its ensuite. Some are even going to the point of actually putting a kitchenette in. So you're looking at these 3-bedroom, 3-bathroom, 3-kitchen homes. Effectively, what that's meaning is you're building a 1-bedroom apartment. To be able to pull in somewhere around that $500 a week for something with its own kitchenette, or $300 for its room with its own ensuite, is very doable in a good, solid area. You can't do that in the Greenfield area, the new estates out west or wherever it is. You need to be building that in an established suburb with the infrastructure around it. But really, looking at a 9-10% return on that co-living. And I'll let finance talk about that from a finance point of view.
If I can just jump in there,
Yeah.
I think, so there's a few distinctions here. I know I had a friend who bought a house in Paddington in the 2010s, and he converted it into like a boarding house. Now, so that's one strategy, and that's kind of co-living. We didn't call it that back then, but so that's essentially what co-living is. But now what you're saying is instead of buying a property that's sort of you can ramshackle into like a boarding house situation, you're basically saying that there are new builds available where the builder will start out from scratch building a co-living accommodation, right? Go into that. Talk to us about the pros and cons of that compared to finding your own property.
Oh, great question. So it's and thank you for the distinction there. Buying an old home, one, you're buying it like a second-hand car. You're buying the problems. So what's underneath the skin of the house that needs repairing in the next 3 or 4 years? So very possibly repair costs are higher. Going through and renovating and putting those extra bathrooms in. Bathrooms and kitchens are one of the biggest costs of building a home. And so actually modifying to actually make those bedrooms have their own bathrooms just adds the cost. And you might buy something for $700,000, but you spend $150,000 just fixing it up to make it suitable. You can go and buy build a 5-bedroom house on a really nice block of land for $800,000 without all the effort, without all the stress and effort. And you've got something brand new. You've got the depreciation that comes with it. Tax is not the reason to buy a property. It's a benefit of buying a property, the tax benefits. But you're starting from scratch and you're starting with new. So you're going to get a better return right from the top without that extra money being put into it.
So let's just kind of recap. You're saying you can buy something like this for $700,000-800,000 in a good location that's got the right infrastructure around it. You're going to get around 8 to 10% rental return on this. So it's a high return property, right?
And it's also high growth.
And it's also high growth because it's in an area that's surrounded by that infrastructure. And so
that's it.
And basically what you're saying is because of the rental demand for a property like this, because the rental crisis that we're in and because of the supply demand issues, you're basically saying this is safe as well. So you've got high return, high yield, high growth, property, that's affordable. I mean, relatively affordable. It's not the $400,000 one bedrooms that we saw back in the early 2000s.
No.
We're definitely in a new era, but you're in that 700,000 to 800,000, which I think is reasonably accessible by most people.
Oh, very definitely. And that price point, I mean, back in the early 2000s, yes, you look at $300,000. In the early teens, you look at a $400,000, $450,000 house as that bottom starting point to get in the market. By 19, we're looking at that sort of $600,000 as a bottom point to get into the market. Now, in 25, we're looking at that $750,000, $800,000 is the bottom point to get into the market.
Just before we jump into SMSF, which is the second one, I just want to ask Dom or Beck, what does somebody need to get into like a $700,000 or $800,000 property in terms of and what kind of LVR are the banks looking for? Give us a little bit of background.
Yeah, so to get into the co-living, it's a bit different to your regular, like just buying an everyday home. But you need around about that 20% deposit plus costs. Depending on the property, you might be able to go to 90%, but I think safe to sit at that 20% plus costs to get into that one.
Okay.
And I might just jump in there really quickly, Joe, if you don't mind. I always have a look at, the funding lines that are available from lenders. There are funding lines available for co-living. They understand the asset, the property structure of it. They understand the yields that are coming, and it's an asset class or a property class that is in high demand at the moment. As Duncan also said, we all understand it's the land that goes up in value. And when you're purchasing in the right areas where there's heavy and high demand, it doesn't matter what you put on that parcel of land. It's the land that goes up. However, fundamentally, co-living is a very high yielding piece of real estate that is in very, very high demand at the moment as well. And I think that I might just add to that too, Duncan, if you don't mind. If you just have a look at the design of the co-living homes, they are genuine homes. They're not backpackers. People make this assumption that it's a backpackers. They are very, very good-looking, modern homes, well-built, and I think it's a great asset class.
Very interesting.
Perfect. Thank you.
And I think, Mark, we're going to segue here into SMSF. I think there's an opportunity here for people who, may have equity, they may not have equity, they may have a deposit, but certainly another way of getting into this co-living is through an SMSF. Did you want to kind of move us into that realm?
Yeah, look, SMSF is pretty much a tax structure for investments. It's the best tax structure in Australia because you only get taxed 15%. And the great thing about SMSF is that you got access to pretty much unlimited investment options such as property. And it also gives you the ability to leverage, right? So, which accelerates your wealth. So, for example, if you had a $200,000 super fund, 10% return on that would be 20%. But then if you've used that $200,000 super fund to purchase properties, let's just say for $500,000, and then, all things being equal, if that $500,000 property makes 10%, then you're getting $50,000 return. So that's 2.5 times better than you would have if you just had a normal super fund with no leverage. And also you're able to have as much as 6 members in the fund. So you can pool your funds, with your partner or your family. So you have a bigger balance, and then with a bigger balance, you're also lowering your fees. And lastly, superannuation fund is a separate entity to your current personal finance. So, for example, if you've maxed out your personal borrowing capacity under your personal name and you're looking at investing into property, you can do that in your super fund because the banks, look at you as a separate entity. And like I said, from a tax point of view as well, if you've got property in there, rental income only gets taxed at 15%. And because property is a long-term investment, if you're looking at selling that property in your retirement, that's where you reap the rewards of the tax, where it becomes a tax-free environment.
Yeah. Yeah, I mean, I think that's probably self-managed super funds have certainly matured over the last 10 to 15 years. They were not well understood when they first came out. There was a lot of, back and forth around, how they actually worked and who, how to set them up and things like that. And I know that people have set them up themselves and sometimes have done themselves disservice. But now I think it's much more well understood by banks. It's a real, it's a really good way of leveraging those funds that you've got. And if you don't have a self-managed super fund, I think what would your advice be in terms of what's the minimum that somebody needs to really set up a self-managed super fund? And I think I'll just add to that, because you've also addressed that you can get other members of your family also together. So, from a group perspective, maybe you've got 100 or 200 already there, but maybe somebody else has got some more. So maybe give us some guidance around that.
Look, it always goes down to what you want to invest in. But if we're talking about from a cost perspective, where the self-managed super fund actually becomes more cheaper to run than your normal conventional industry funds, the balance will be around roughly about over 250,000 combined balance with all the members in the fund. But yeah, it goes down to what you want to invest in, if it's property or shares and so forth, but there is no minimum amount.
Anybody else want to come in here? Duncan, do you want to talk about self-managed super fund investing?
Well, and I only at a very high level, and I'm sure, Mark, any one of these topics we've got here, any one of these investing strategies, we could spend truth, an hour and a half on with getting into the real nitty gritty of it. And Mark just, only hit some really high points on the benefits behind a self-managed super fund. Anyone in their 30s to 40s, anyone that can put together, husband and wife or family can put together that balance of $200,000, $250,000 is really setting themselves up for a beautiful asset class to take through that actually serves them into their retirement. And definitely from that tax point of view, as he's pointed out, the sorts of properties you put in there. The one thing I will say about anything you invest in from a property point of view inside super, once it's in there, it's in there. You can't go and modify it. You can't go and add a granny flat on the back. You can't do renovations. It is what it is. And so the asset that you're actually putting in there has to be 150% perfect to put in there in the first place. And when it's outside super in our own names, we get to modify it. We get to play with it a bit. We can do things with it in most cases. But inside super, no, that asset has to be really good quality blue chip, really good ongoing rental returns and drivers behind that consistent growth in it, because that asset is just going to perform for you over the next, sometimes 15, 20 years before you actually really get to reap the benefits of it from a super fund point of view.
Yeah, good advice.
Yeah.
And I think that's good. I mean, having been in property a long time, the itch and urge to go and fool around with something often ends up in more pain than you want, right?
Very definitely.
So it's kind of good set and forget strategy. Yeah. Anybody else before we move on to high yield NDIS?
I'm all right with.
No, we're good.
No.
All right, I'm going to throw it back over to you, Duncan. Lead us through NDIS. This is something that I've seen lots of ads. I've seen lots of Instagram posts about NDIS. I know that it sounds pretty good. I know that there are some pitfalls as well. Maybe take us through a little bit more in depth NDIS.
We'll talk one of our case studies a little bit later on. We'll talk about a client doing NDIS investing and actually self-managed super fund investing as well with NDIS. NDIS, sort of like being a Trump supporter or not, there's a lot of press out there around it. Some really good, some are really bad, unfortunately. And NDIS, everyone, and I'll use the word spruikers, have jumped on the bandwagon. And by definition, a spruiker is someone that really goes to the nth degree to tell you about something and has gone to the nth degree about promoting self-managed super funds. And I only literally spoke to a client this morning who got involved with the company last year. They got into the NDIS. They wanted to go on NDIS. They were buying the land to go through and put the NDIS property on. And all of a sudden, the banks went, shh, we're changing the rules. And literally came down. They could have come in with a rock pick, but they came in with a sledgehammer sort of thing, like they good old banks do, and just blanketed everything. Right, postcodes, we're not going to build NDIS homes here anymore because we're getting too many people buying. Why were they getting built there? Because the land was cheap and developers could sell the land with, look at this, we can sell a high yielding property in this area. So it became very attractive for the people that weren't educated. They also turned around and said, right, lending, we're going to only allow people $2.5 million in equity sitting there to be able, and $250,000 income to be able to do one of these. We need NDIS properties. The challenge was they were being built in the wrong spots because the land was cheaper. And the bank didn't do it eloquently at all, has put a real cap on that. NDIS, we need NDIS housing. And the government is not going to solve the need for this affordable housing or this housing for this group of individuals that are in our community. There's tens of thousands of people that need community to have this sort of housing right across the country. They just need to be built where it's of use to those clients actually moving into these properties. So NDIS, yeah, beautiful. And you talk about co-living being high yielding. You might talk about a 5-bedroom house for co-living giving you $1,500 a week. An NDIS house will give you $3,000 a week.
Correct.
Pretty much for around the same price.
Yeah.
More. Now, you are building these homes very high spec. The co-living homes had the bathrooms, etc. in each room. NDIS, the structure in the roof can take a hoist, etc., etc. So there's a little bit more infrastructure that goes behind it. So your building cost does go up even more, but the return is significantly higher. They can still be built. It's just a matter of working with the banks, working with the system to make sure that we're actually building, one, in the right areas, that we can actually put a tenant into the damn thing, and two, that the banks are looking and going, yeah, this actually makes financial sense and we're prepared to lend the money against it.
Becky, I think you sort of were ready to jump in there.
Yeah, you bet. And the reason why is arguably the Move has been one of the largest mortgage brokers in terms of the level of volume in NDIS home loans that we've written. It's a product that we understand incredibly well. And when I have a look at the journey, when we first started writing loans for NDIS, and you have a look at the builders behind it, well-known builders, great brands, the site selection was very, very detailed. Even there were government websites out there that gave you all the statistical data about the demand, and it worked incredibly, incredibly well. So when I have a look at, and we study our loan book, let's call, I think at that time it was about 158 odd home loans, NDIS loans that we did. Every single one of those eventually got participants. Sometimes it had taken 4 weeks in the early days, and it stretched out to as long as 3 months. However, when you have a look at the returns, and they're 15% plus, and we're talking about net, the level of support that the banks were giving it, and as Duncan said, unfortunately, what happens when there are government-backed properties like this and government-backed schemes, eventually the spruikers start to get in there. Some of the rogue builders, as Duncan said, building in the wrong areas. The property's ready to be handed over, yet the footpath, for argument's sake, it hasn't even been sealed. It's still crushed rock. All the roads are crushed rock. You can't even get a wheelchair on it. Unfortunately, government departments, the way that they operate and act, and some lenders don't do the research themselves, and then the pressure comes on to people like us. However, stay patient. It is a market that will open up again, and it's great for the industry. It'll come with a strict level of compliance and that as well, which is great for all of us. And I'll finish up on this. If you understand the disability in Australia and the rate at which it's actually increasing, it puts a lot of families under pressure that have to accommodate a disabled family member. Just if you understand it, it's a hell of a lot of pressure. The federal government is so far committed with NDIS, there's no going backwards. They have to continue to support it. But I'm a very, very big fan of it and a big advocate when done correctly, obviously.
So let me just put that final question to you guys. I think we said at the beginning of the segment, which is better, co-living or NDIS? And it sounds like you've got some caveats and some things that if NDIS is structured the right way, if it's in the right locations, it sounds like that's a great opportunity. But it also sounds like that it's an opportunity that's not so available now. Maybe just wrap us up and say which one is better, co-living, and put some boundaries around that.
Great.
I might start if you don't mind.
Yeah.
I don't mind. I'll start if you guys don't mind. I just look at it from a funding line perspective. What's actually happening in the background? The funders are cleaning up some of the let's call it toxic loans that they actually have. There's a lot of work being done in the background on new compliance policies, all the additional requirements, even getting sign off in terms of whether you've been with an SDA provider, where are you at with getting participants, which is the right way to do it from that point of view. Once that is set, when we're not too far off that, the funding lines will open up for people that are purchasing NDIS property. But I'll always say this, be very, very cautious who you're dealing with. If you're starting with strategic property, that's a great start because you've come through the right doors to start with from that point of view, having a look at the research that they do, the level of detail, all the compliance that they go through. But you're in the good hand. You're in great hands when it comes to obviously the property purchasing process. And I'd like to say you're in great hands when you're with the finance people in the Move as well. So I might just give us a little bit of a pat on the back while I've got the floor.
Good on you, mate. Good on you.
And I'll give myself a little pat. Thank you very
Absolutely.
much. Becky, that's really appreciated. In just summarising that, which is better? Look, from a yielding point of view, obviously, NDIS property is a better yielding property. To get to that full return on the property can take, as Becky rightly said, can take 2-3 months sometimes, if not even a little bit longer. What people are forgetting is that property, even if it's not rented out as an NDIS house, can still be rented out as a co-living house because every room's set up with its own bathroom as well. So you might not get the full $160,000 a year income, gross income out of it. You might only end up with, $80,000 income out of it a year. It's still an 8% returning property. So which is better? Yeah, NDIS is better. There's a lot more loopholes and a lot more steps to take to do that. And Becky, again, rightly said, the specialists are involved. I mean, the team that I work with, that we work with, we've got one guy that just finds properties, just finds the blocks of land. Then we've got the SDA provider who actually goes out and checks out the block of land and actually gives a due diligence report before you even sign off on the block of land. Every single step is taken care of, and that's what you need to be doing. You're investing $1 million in some cases when you're doing an NDIS pro. That's a lot of coin to put down the table. You want the best return on your investment. I'll be quiet.
Great advice.
Great.
Great advice. And it sounds like a couple of real experts who've seen the good and the bad. Any final words before we move on to the next one, which is first home buyer rent vesting? No? All good?
No, all good.
All right.
I might just put out there though.
Oh yeah.
So I was going to turn my camera off for 2 minutes, and I'll be back in 2 minutes. My apologies.
No worries,
No, you're right. I might just point out there just one thing with self-managed super funds with Mark. A co-living property, so a house and land package, and a high-yielding NDIS property, which is generally a house and land package as well, traditionally it's a two-part contract. You buy the land and you put the house on top of it. From a self-managed super fund, you can't do a two-part contract because that's seen as improving the block of land. You can't do that. You can actually turn that contract into a single-part contract to put inside your self-managed super fund. So yes, it is possible to do a single part contract or a house and land package inside super. It's just the way it's structured and the way it's put together. And Mark, I'm sure you can attest to obviously the positive side of the yield that would be inside the super fund as a result of that as well.
Yeah, no, definitely. If you are looking at property in the self-managed super fund, you want to position that property as being positively geared, so a high yielding property. So it's a perfect property to have in the super fund, because if you've got a negative geared property, essentially, because superannuation fund is already a low tax environment, you're not going to get the same tax benefits. On top of that as well, the equity that you build on the property in the self-managed super fund, you can't actually extract that to leverage and buy another one. So what you want to do is build your funds up with a higher yielding or higher income property, so that funds that you are building essentially is your equity that you're building that you can later down the track use as a deposit to buy another property in the super fund.
Great. Some really good tips there that most people I don't think would know about in terms of how to package up that NDIS or co-living property into a self-managed super fund. So thanks for that, guys. Real experts here with us. So with that, let's move on to number 4, which is our first home buyer rent vesting strategy. And then we'll wrap up this segment with the off-market opportunities, which should give us that little bit of time left over to show our people online the case studies where some of these things have actually been put into place. So off with you again, Duncan, for number 4.
Well, first home buyers versus rent vesting, and it's really it's one of the two. As the strategy goes, there are so many young Australians that are struggling right now. One of the sheets, the affordability is at its all-time high. Being able to actually save for a property and actually save up enough money for a deposit for a property, etc., etc. So a lot of first home buyers, instead of actually going and buying their first home and living in it, are looking at that rent vesting. So yes. Just because you're a first home buyer and you haven't got a lot of deposit doesn't mean you can't be investing. And if you don't really understand the difference, when would now be a great time to sit down and actually have a chat with one of the team just in regards to how that actually works out. But rent vesting can be a very powerful way for a young person, even a person that's gone through a change in life, to actually be able to invest into a property.
Let me jump
out of it.
Sorry, Duncan, let me just jump in there. So just to clarify, so rent vesting is defined as you rent, but you still invest. And you may not invest, let's say if you're renting here in Sydney and you've got your friends and family and you've grown up here, Sydney might not be affordable for you, as you say, in different stages of your life, whether you're young and just getting started, or maybe you've gone through a relationship separation or whatever like that, and you're sort of starting over. So you're saying you can invest somewhere else, a great area somewhere else in Australia, while you remain renting in the place that you want to live in. to get you started on that property journey, or to continue your property journey.
Yeah, and I'll use that as exactly right. And I'll use that at one of the case studies just at the end there, where we can go through and we'll talk about two clients that did rent vesting instead of doing that first home buyer and the benefit behind that for them.
Yeah.
Yeah, definitely.
Great. Do you want to talk about off-market opportunities?
Me, definitely. Off-market, the only way to buy. Sorry, I was thinking that Dom might have come in with some finance.
Oh yeah.
On,
I'll jump in quickly for the first home buyers.
Right.
So look, there's multiple different avenues now for especially first home buyers getting into the market. People always say it's always so hard to get in, which it is hard if you're traditionally saving that 20%, but there's the first home deposit schemes, which is basically just 5% deposit, and then the government will guarantee the LMI. So it's not the government owning anything. You still own 100% of the property, but you're putting down a 5% deposit, which is a lot easier to save than that full 20. So yeah, just being aware that there's multiple different ways you can get into the market as a first home buyer.
So maybe go into,
and off the back of that. Sorry, Joe, go for it.
No, I was just going to ask to get into some more of the details there. So you're talking about a 5% deposit, and what are the requirements of a person that's doing that? Is it really your first property transaction, or what are some of
the? So you don't as long as you haven't owned a property in Australia before, you can take advantage of the first home buyer scheme, which is 5%. And then you also get the first homeowners grant as well if you qualify for that with a brand new home, depending on state to state. So yeah, that's that. You can invest in property and still get the first home buyers grant and the stamp duty savings, but you just can't use the first home scheme in that case.
I just might jump in there too quickly, team. What I've found, and what I also know, is that Dom's actually written quite a few of these type of loans for first home buyers. I'm absolutely flabbergasted why first home buyers are not actually taking advantage, of all the schemes, the government-backed deposits, et cetera, that's out there. And I think it's due to education. There's not enough people that actually understand it, how it works. So what I might do is sit with Dom and actually prepare a bit of a process and the journey and exactly how it works, and then hand it over to the great team at Strategic that can actually email it out. Because especially once parents get to understand it as well, they'll actually push their kids to go and buy their first home, because it's never been around previously to this level, the amount of support that is available out there. And it's just an education process. It's not promoted enough, and I think it really, really needs to be.
Well, yeah, just for instance, if you're in Queensland buying a brand new home, a first home, you get $30,000 first homeowners grant, no stamp duty, and then that's the 5% required. So it's literally $0 in to purchase effectively for that $600,000 mark.
It's crazy.
Very good.
It's great.
Amazing.
And you're right. Just touching on that, yes, it's all about education. And if you don't know, people don't know what they don't know that they don't know that they don't know. And it's that ongoing say, until you actually sit down with a team that actually has that knowledge and experience behind it, you're flying blind.
Yeah, correct. And if there's any parents online at the moment that are sick of having their kids at age 30 still living with them, get them in touch with Duncan immediately, or the team at Strategic, and we'll put a process in place to get them out there for the right reasons. Though they're buying their first home, and they have to take advantage of what's out there.
Yeah.
Now, I actually have to depart now, because I'm actually sitting down with one of our potential funding lines for NDIS as well. And it was the only time that I could fit them in was 1 o'clock, and I've only got about 15 minutes to get there.
Go for it.
Thank you, Becky.
It's been a pleasure being a part of this as well, and I look forward to actually meeting some of the clients and potential clients that are online.
Thanks very much. Cheers.
Great work, guys. Cheers.
Bye.
Off market, I might jump straight into that.
Let's do that.
Look, off market, nice and quickly. I don't want, when I'm working with a client and they're buying rules, we've created a strategy, we've got them finance ready, we've got them understanding where they want to go and down a path. I don't want to go out to the marketplace and look on realestate.com for a property, because there's a bunch of other people who get that same property. And then I get into a whole bidding war with that whole process of securing that property for that client. I want to be able to go in and find a property that's off market that I don't have to worry about the marketing fees and costs that have been added to it because they're advertising it online. And so all our properties, 99.9% of the properties that we work with our clients, that we secure for our clients, are off market purely for that reason. We don't want to be out there. And the case studies we'll go through, all those properties were all off market. And they're looking at somewhere between 5 and 10% upside just because they bought it off market versus buying it on market. So I've got nothing else to say about that at this point in time. It's the only way to buy property is buy it off market.
That's great. So thanks for that, everyone. So just to recap, the 5 best property investment strategies in 2025, we've got co-living, which is basically a newly built house that's set up specifically to have multiple tenants in it. It provides, and if it's purchased in the right locations, it's going to grow from a capital growth perspective, and it's also going to give you that high yielding return. So we've got all 3 things. It's safe, it's high yielding, and it's got a high return as well. SMSF, that's a great way of pooling your funds with other family members, creating a set and forget asset that's going to grow over time, and hopefully you can put more and more properties in your self-managed super fund. High yielding NDIS. It's been a little bit of an up and down saga with that, but it's coming back to life. We expect to see more NDIS coming out, but one of the keys there is choosing the right location for the NDIS property so that the bank and other parts of the process work well and smoothly. Then we've got first home buyer and rent vesting. I think the outcome there is that there's huge opportunities for anybody who's a first home buyer who hasn't had a property in Australia before. That could be somebody who's migrated to Australia, or kids and family members who haven't owned their own property. So many schemes, and great to have a team here that can help shepherd people through that process. And then lastly, off-market opportunities, the best way to buy property because you're not competing against the whole rest of everybody else on realestate.com, and you've got a built-in 5 or 10% upfront kind of savings or growth with those types of opportunities. So with that, I'm going to shift gears here and let's talk about some of the case studies. Now, Duncan, you had a few slides here that were just talking through the supply and demand issues.
Look, I think we could fly through them very quickly. Look, when it really comes down to it, fundamentally, being in this industry for the last 30, nearly 40 years and investing in that same period of time, housing's gone through all different changes and ups and downs and swings and roundabouts. We've had all these economic impacts on our country and internationally as well. When it really comes down to it, we haven't got enough homes in Australia. And right now, the government, the big thing is let's build lots of homes. And they've committed to building 1.2 million homes in Australia by 2029 in the next 5 years. The challenge is that everyone, and there's a number of slides here, everyone is sitting there going, we ain't building enough. And if you break that down, 1.2 million homes, that's 120,000 homes every 6 months that need to be built. In the last 6 months, we built 93. Sorry, in the last 12 months, we built 93,000. We're a little bit behind the target. And yeah, definitely by 29, we're still going to be 300,000, even with the federal government, even with all these incentives. What does that do? When you really look at it, and you look at there's approvals, even with the housing approvals being up and the highest it's been for the last 3 or 4 years, it's still not enough. We're still great. The approvals are up and people are building more homes. We're still way behind the numbers. ABS is also sitting there saying we're not building enough homes. We're not going to do that. We're not going to get the results we want. If we go through and keep jumping through a bunch of slides there, because it's really just, I had some really good slides around that. Simply, we're not building enough homes. And when it really comes down to it, it's that supply and demand. And when we add into supply and demand on the next slide there, Joe, when we add into the supply and demand being out of whack and we're not building the homes, we then start looking at the affordability. We then start looking at how much does it cost, how long does it take us to save for a house at this point in time. Statistically, we're sitting at around 10 years now to actually save a deposit for a new home. Have I jumped? Where's your slides gone?
So, look, I'm just going to go straight into the case studies because I think we've got about 8 minutes to go. I
Done.
want to
Yeah,
make
let's
sure
do
we get
that.
a couple of good ones in there just to illustrate to everybody. I think we've got some slides here. We can package this up and send this out to all the participants on today's call. So you can rest assured to receive that in the mail. We've also set aside a free strategy seminar or a strategy session with Duncan to come up with your 2025 strategy. So don't worry, we'll send that out for you guys. Let me just go through these slides here quickly, and let's get to our first home buyer success story. So talk to us about Nick. Duncan?
Nick, his mum was a client of ours a number of years ago now, and this is one of my first home buyers. Mum said, "Hey, look, I can't get my son to do it." She already had 10 properties herself, but son wouldn't listen to mum. Go figure. Nothing's changed in the last sort of 10 or 15 or 20 years, 100 years. Sons never listen to their mums. Sat down with us after about an hour and a half. We're sitting down. This guy really wanted to buy a GTR because he wanted to be with his friends. He had $70,000 saved up. It was a really good situation. Through conversation, actually showing the outcome, he ended up buying his first place. And he bought it as a first home buyer and utilised the grants at the time. But that was, 10, 15 years ago now. And this guy now has, a number of properties. He's living in Singapore. He's got a couple of really nice cars, including the GTR that he drives around. He loves it, all classically kept nice and original. But it was simply the fact of someone sitting down and showing him what was possible.
So let's jump to the next one. That's a great story. It's a little bit older, but what about this gentleman here?
Oh, Anthony was self-managed super fund and high yield. Look, this was a beautiful example, and this client only came to us a couple of months ago, and he's had so many questions. He just didn't know, and he was getting so much input from all these different places, and there were conflicting stories, and you could see him, just his head was spinning because there was so much information and misinformation out there. Getting down and drilling down into the basics of what he was wanting to achieve in his own name and for his family into retirement and his super were the three things that were really driving him. He was quite successful, built a beautiful house already, had a huge amount of equity in this property that was untapped, but he didn't know how to access it. He thought he couldn't access it. Through some structuring, sitting down with Dom, really looked at putting together and pulling some equity out of that property and also one of his other investment properties, topping up his super. So there was two strategies here. He took some money and topped up because he was allowed to top up the balance in his super fund, which is allowing him to buy a property in his super fund. So tick, that's one property done, and that's just completing now. In his own name, we're doing one of these high yielding properties. We're actually doing a co-living property, but we're actually doing it as a hybrid and turning it into an NDIS property, which is sort of a workaround to get a person into that really, really high yield of about $160,000 a year into that 5-bedroom home. So both properties are underway now, and he's in a really good situation. Now, that's obviously setting him up. Now he's actually created that. His work income isn't nearly as important. So he's working his butt off his own job because he's got this high yield coming in off the property. He's now situated himself to now go and do another property, and that'll be the next step in the next few months to go to that next step for him as well.
All right, let's shift gears. We got about 5 minutes left. Let's
go for it.
Let's get a couple
Archie
here.
Archie or Archna, wonderful lady. Look, in her mid-50s, already had a couple of properties to herself, but she was cash flow poor. She was asset rich, cash flow poor, so was really struggling. And after some really long conversations and getting her to move out of her own property, her principal place residence, just a really nice residence, but renting that out, it actually made her serviceability and her ability to actually go out and buy some more investment property much more affordable. And from a finance point of view, I know that Dom would talk about that being an investor instead of living in your own home, much more tax effective. And so, look, as a result of that, she's bought a couple of properties. She's doing one into a self-managed super fund as well in her own name. And as a result, her daughters went, "Struth, Mum, how'd you do that?" And both daughters have both now also come along. They bought their first property. That's all secured and settled. And they've gone and they're both into their second property as well, which is wonderful. Those two weren't going to do anything. They were stuck in their way of thinking in education. So a wonderful family story for them.
Hey, before I noticed that we've got a question here from John. He said, "What about Defence Force housing?"
Great. Defence Force housing is wonderful. It's a beautiful way of investing. You really got some very set processes in place with the Defence Force. They'll put the person into the house for up to 10 years. They'll rent that property. They'll renovate it when you finish with the property as well. So it's a really good return on investment. Or the good rent return on investment. The challenge is that they take quite a high property management fee in that process. So the return on investment, you're stuck in those areas where they want their employees, they want their tenants to live, the armed forces to live, not necessarily getting into an area where highest growth is or the best yields are. So sometimes spending the money elsewhere, it's always good to compare apples with apples and, okay, this is what they're offering. What else can I do with the money in another suburb or another state? And when you actually compare the numbers, that's the important thing there, because it's not a matter of the color of the picket fence or who your tenant is. It's a matter of what sort of return, what sort of growth we can get out of that in the long term. And investing is long term, not short term. Great question.
Yeah, I think safety is a key concern for many investors, right? And so you really feel the safety that comes along with Defence Force housing. But I think what you're saying there, Duncan, is that you can still have the safety because of the supply and demand issue in Australia that's going to exist for quite a long time, but also get higher yielding and higher return properties, right? So it's definitely a strategy to look at, but you may also consider some of these other strategies as well.
Definitely. Jump down to who have we got? We've got Jack Carr. Jump down to Lockie. I think just one. Jack and Carr in their 40s, got a couple of kids. They bought a couple of properties into their own name and also self-managed super fund. Look, if we jump to go past and just go to Lockie if we can. Lachlan.
All right, let's do Lachlan. And just to let you know, we've only got like 1 minute left. Is there any final words that you want to say to the people before they get on with the rest?
They jump off. Look, sit down. Let's have a chat. If you aren't clear on what your investment strategy is, make a time. We'll send you out a link. Make a time to sit down, have a chat. The calendar's open. You can see we're pretty laid back in our approach. And education, it's all about education and getting you to an informed decision. And when you come from an informed decision, you make better decisions. When you don't really understand, you'll operate very possibly from an area of scarcity or really not knowing what's going on and possibly make an emotional decision rather than a good decision. Yeah. Right. So thank you for those that need to pop off at the hour. But look, if I will, for those that are going to hang in there, I'll explain Lachlan and then we'll just explain our process after that. But right. Lachlan, young guy, living with mum and dad, living in Sydney, had saved up some money. But yeah, good old banker mum and dad supported with a little bit more cash going into it. But he bought his first property in Queensland as a first home buyer. So he actually worked and used that system of those grants that were there and actually got some significant grants out of the government for that. You were talking about the $30,000 before. But that property, he bought in 2022. It's now worth over $1 million. He's gone and pulled equity out of that property a couple of times now, bought a second property and a third property and a fourth property. So he's now 23 years of age, started off with $30,000 effectively of his own money. And he's now got equity. If he sold everything today, he'd have about $1.5 million before tax.
That's pretty impressive. And I think it underlies one of the things that I've struggled with as an investor myself, which is not investing fast enough after you've built some equity. I kind of have allowed a little bit too much time to pass because I haven't had an advisor my whole investing career that has pushed me and said to me, hey, this is what's available. This is what you can do with it. And I've just kind of sat on the opportunity too long. I think this is a great example of somebody who's had your advice, who's been able to be pushed along at the right time, because refinancing a few times in only the first 2 years of owning a property, most people wouldn't say that there's enough time that's passed there. But obviously, if you want to aggressively build wealth, and we all do, like we all, don't want to work our 9 to 5s. We all want to be able to, live like this. This is a great example of really doing things at the right time rather than, what you might have just kind of naturally done from your own comfort level.
Yeah, and thank you, Joe. It's so true. He bit off a heap. Like he's been chewing like hell for the last 3 or 4 years, and especially with interest rates going up. It's been very challenging for him. And no, he's not partying as hard or taking as many holidays as he would like. Sort of like Nick with the guy with the GTR. But Lachlan now, his goal was 3 by 23 and 5 by 25. Even if he just stops at the 4 now and does nothing until he is 35, the amount of wealth and equity and cash flow that this young man is going to have, there's no time better to buy a property than right now. He's done that, and that compounding growth, and that's one of those wonderful wonders of the world. Compounding growth is there. It's going to keep working for it.
And look, I just want to extend that to people who are a bit older. You might be 40, 45, 50, 55. This is still possible for you, even starting over, right? Look at what he's accomplished in only 5 years. Anybody could accomplish the same in only 5 years.
And let's just put a number on that. He just wasn't earning a lot of money. He's earning 75,000 a year now in his job. So he's achieved that with the rents and his job. So anyone, and there's a lot of people listening very possibly that are earning much more than $75,000 a year. So it is possible, very, very possible. And it's just a really good example. And there's many more stories like that. We won't go through all the slides because I just felt that was a good one as a rent investor and first home buyer. Cool.
Great, Duncan. Well, look, I think we're about 3 or 4 minutes over. I want to thank everybody here on the panel for coming along and contributing. Lots of great energy today. I want to thank everybody else who's attended today. As we said, we'll send out some follow-up emails, and be sure to book in that time with Duncan to get your strategy ready, set, go for 2025.
Beautiful. Thank you very much for your time.
Cheers, everyone.
Cheers, guys.
Cheers.
Any other questions come in? Just interest?
Let's see. That was the only one.
That was the only one. Good. And that's good. That's wonderful. Thank you, Joe, very much. Thank you, Mark, and thank you, Becky, as well. I know he's run off to go and speak to that BDM. And Dom, thank you very much.
No worries.
We'll follow through. I'll stop the recording now and